All right, class, settle in. Let's get started.
Today, we're going to dive into something absolutely critical if you're ever going to advise non-resident clients who own rental properties here in Canada. We're talking about the Section 216 election. Now listen up, because understanding this is, frankly, non-negotiable. If you get this right, you can save your clients a ton of money, literally thousands. But if you get it wrong, well, the consequences can be pretty severe. So let's get right into it.
Okay, so here's our game plan for today. First, we'll look at the big problem we're trying to solve. Then we'll introduce our hero, the Section 216 election. We'll run through some numbers to see how it works, check out a proactive approach using something called an NR6, and then, and this is super important, we'll cover the deadlines and penalties. We'll wrap it all up with the key things you need to remember.
All right, first things first. Before we can really appreciate just how powerful the solution is, we've got to get a solid grip on the problem. You see, for landlords who don't live in Canada, the way the tax system is set up by default, well, it can create a massive headache when it comes to cash flow. And here it is. This is the number at the very heart of the issue, 25%. So here's how it works. Under our tax law, your client's Canadian agent, maybe their property manager, has to withhold 25% of their rental income, and they send that money straight to the CRA. But here's the kicker, the most important word on this slide, gross. We're talking 25% of the gross income.
So take a look at this comparison because it really lays out the problem perfectly. When we say tax on gross income, we mean it's calculated before a single penny of expenses gets deducted. I'm talking mortgage interest, property taxes, repairs, you name it, it doesn't matter yet. So if your client brings in $20,000 in rent, a full $5,000, poof, is withheld and sent to the government right off the top. And you can imagine that $5,000 is almost always way more than the tax they'd actually owe on their profit. That's a huge cash flow problem.
So how do we fix this mess, right? This is where we get to the core of today's lecture. It's a really elegant solution, actually, and it's found in Section 216 of the Income Tax Act.
Now, the most important thing to get here is that this is a choice. It does not happen automatically. By making a Section 216 election, a non-resident gets to file a special Canadian tax return. So that 25% tax on the gross income, it's no longer the final word. Instead, this election lets us recalculate the tax based on the actual net profit, just like we would for any Canadian resident. So why would anyone go through the trouble of filing this extra return? Well, the reason is simple and it's powerful. It's all about the money. Because that 25% withheld on the gross rent is almost always way higher than the actual tax on the net profit. Filing a Section 216 return, well, it almost always triggers a pretty substantial tax refund for your client. It's that simple.
Okay, theory is one thing, but let's put some real numbers to this. It'll make it crystal clear. We're going to walk through a case study. This one's actually right out of the CRA's guide about a non-resident landlord who lives in Peru.
All right, let's break this down. As you can see, the property brought in $12,000 in gross rent for the year. From that, we subtract $6,000 in allowable expenses. Then we also get to deduct another $1,000 for capital cost allowance, which, if you remember, is just our fancy tax term for depreciation on the building itself. So you do the math, and that brings the taxable net rental income all the way down to just $5,000. And here is where the magic happens. Look at the difference. The agent had to withhold $3,000 throughout the year. That's the 25% of the gross $12,000. But by filing the Section 216 return, the actual tax owed is now calculated on that tiny $5,000 net income figure. And obviously, that's going to result in a much, much smaller final tax bill. So what's the end result? It's a refund. The difference between that $3,000 that was withheld and the much smaller final tax bill, that gets paid right back to the landlord. That is the direct financial payoff of making a selection. You're basically turning a massive tax overpayment into cold hard cash back in your client's pocket. Okay, getting a big refund at the end of the year is great, right? But for clients who aren't so keen on giving the government a huge interest-free loan for 12 months, there's an even smarter way to do this. We're going to level up our planning here. Let's talk about Form NR6. I want you to think about it like this. The Section 216 return is a reactive strategy. You're reacting at the end of the year to get overpaid tax back.
Form NR6, on the other hand, is proactive. It's a special form you file with the CRA that, if approved, lets the agent withhold tax on the estimated net income right from the start. This makes a massive difference to your client's monthly cash flow. And the process for this is pretty straightforward. You and the client's Canadian agent fill out the NR6 form together, and you put down your best estimate of the annual rent and all the expenses. You have to submit this to the CRA for approval before January 1st, or at least before that first rent payment is due. Now, this next part is key. You cannot do anything until you get written approval back from the CRA. But once that letter arrives, your agent can flip the switch and start withholding 25% on that much, much smaller estimated net amount. Okay, and this is probably the most critical administrative part of the entire lecture, because using this awesome proactive NR6 strategy, it comes with a very serious string attached. This is where I see students and even professionals make incredibly costly mistakes. So I need you to really, really pay close attention to this next part. Let's look at these deadlines, because they're not all the same. See, normally, if you don't file an NR6, you've got a full 2 years from the end of the tax year to file a Section 216 return and claim your refund. Plenty of time. However, if you filed that NR6 form and the CRA approved it, everything changes. The deadline becomes absolute. It's June 30th of the following year. And let me be clear, this isn't a suggestion, it's not optional, it is absolutely mandatory. And just so you don't think I'm being overly dramatic, I want you to read this quote. This is directly from the CRA. It's not a suggestion, it's a warning. If you get that NR6 approval and then you fail to file the Section 216 return by that June 30th deadline, the entire benefit is wiped out. Gone. The CRA considers the whole thing invalid, and they will go back and assess your client tax on their full gross rental income. And if you want to see what that looks like in dollars and cents, well, here's the painful math. In this scenario, the agent did everything right. They withheld $1,250 based on the approved NR6. But the tax return was filed late, maybe just a day late. Doesn't matter. The NR6 is now void. The CRA will come knocking and demand tax on the full gross amount, which is $5,000. So that difference, $3,750 plus interest, is now due immediately. And you know who usually gets that scary assessment notice? The Canadian agent. This is a nightmare scenario that you have to avoid at all costs. All right, let's wrap this up and bring it all together. We've talked about the problem, we've walked through the solution, and we've highlighted the major pitfall. So here's a quick checklist of the things you absolutely positively must take away from today. Okay, let's burn these into your memory. Number 1, the default tax for non-residents is 25% on gross rent, period. Number 2, the Section 216 election is your tool to switch that to tax on net income. 3, Form NR6 is that proactive move that helps cash flow, but, and this is a big but, it makes the Section 216 return mandatory for that year. 4, missing that June 30th deadline after an NR6 approval is a disaster. It's an incredibly costly mistake. And last but not least, remember, a single Section 216 return has to include all of your client's Canadian rental properties, not just one. So I'm going to leave you with one final question to chew on, something to think about for your future careers. Imagine you have a client who just bought a new rental property. Now, think about the early years when they have really high capital cost allowance claims, maybe so high that it creates a net rental loss on paper. How could that situation make filing an NR6 and a Section 216 return not just a good idea, but maybe absolutely essential for their financial survival? Think on that. We'll see you next time.